and welcome again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is October 20th of 2022, and we got a special episode edition of the Market Insights and Observations today. Quite frankly, I've been on the road last week at the Barron's Shook Top Advisor Conference, and a lot of great investment knowledge, peer-to-peer exchange, and actionable ideas for clients, and we'll get to that in the part two as I recap that. As well as earlier this week, I was in Scottsdale with HighTower's investment consulting team and partner meeting in Scottsdale, Arizona. Stephanie Link, if you follow, not only she is a strategic advisor to Blanke Schein Wealth Management and portfolio manager, but also Stephanie was broadcasting live from the HighTower event in Scottsdale. So if you watch CNBC, she was there live, and we've got some photos and fun things and personal exchanges with Stephanie. But more importantly, it was the insight from last week. All the top advisors, all the top minds in the investment world and portfolio managers, hedge fund, private equity managers, those that are allocating capital as we are for clients, both in the short term and long term. Really the big theme here, the take home point is that long term trend of markets last 50 years, 100 years is up. But we get bumps along the road and recessions along the road, and we get contractions along the way. And that's normal, and that's to be expected. And there's things we are doing proactively through our process of Blanke Schein Wealth Management for our clients to get through those periods of bumps along the way or recessions. We've seen them before. We've had clients that are with us for many, many decades. And, beyond that, it's higher highs. But at the same time, we've got these periods of consolidation. But more importantly, we also have the technology. You're watching us right now. So what are we going to do? What are we doing? What are the things that are actionable, things that we could take advantage of, and risks we could avoid for our clients as we are giving you sort of more of a back stage look as to how we're going through this process right now. So as I've been saying earlier this year, mid-year, even a few weeks ago, as markets were selling off, I basically pointed to earnings. We have to see what the third quarter earnings season looks like. And right now, as of we're a third of the way through earnings reporting season right now, and 83% of companies that have reported have met or beaten or exceeded expectations. That's where we are. So it's about a 3% gain on earnings right now. And more importantly, we haven't seen any earnings deteriorations for any corporations, any disastrous outlooks going forward. In fact, right now, the estimate for the fourth quarter, so right now we're in the fourth quarter, and we will see as year-end closes out for corporations and how they fare. But there's still earnings growth of 4.7%. That's the current estimate. Obviously, that could come down, like the third quarter estimate came down. But we're still chugging along at about a 2 to 4% range on earnings growth. Now, where's the growth coming from in the sectors? And that's how we're allocating. We're allocating, obviously, the growth is coming in energy, more so than other sectors in the economy. And that's why you diversify portfolios. That's what we're doing for our clients, because let's be real. Even though energy is only 5% of the overall S&P 500 by weighting and representation, the other 95% of the S&P 500, all the other sectors, can't do their job without energy, because energy goes through. Now, that's an inflationary input, and that's really what the Federal Reserve is looking at, energy as well as jobs. And right now, here's what's going to happen. Here's sort of why the volatility remains high. And I'd like to explain this. So at home, we see markets move, right? The volatility is extremely high, but we want to put a sort of a mindset behind it and some rationale as to what to look for, what markets are paying attention to, what we're paying attention to, and how we're positioning accordingly. But obviously, right now, volatility remains high because uncertainty is so high. I know a couple weeks we've got midterms, but I think that could be shaking out where we'll get past that. And historically speaking, when we get past a midterm election cycle, markets actually trend higher. We don't know if that'll be the case, but historically, it's been very favorable. And why is that? Because you're removing some of the uncertainty from the market. But we still have geopolitical concerns, or even UK concerns. We had the UK Prime Minister just resign. Basically, she's representing the Conservative Party. They basically want to give tax cuts, and that's not right now, at least with the market bears, because more tax cuts means more liquidity in the market, means more dollars are circulating in the economy over UK. Their inflation is out of control. So they want more restrictive stance. As soon as she resigned, markets in the UK sort of started rising, and their 10-year started stabilizing, as well as the pound. So that was a positive for their economy. They have to keep rates high. They can't cut sort of taxes, because that would add more fuel to the fire, more liquidity in the system. Too many dollars chasing too few goods and services is the definition of inflation. So that was a positive sort of reaction over there with markets. But then we also here have the FX trade, as well as the strong dollar across the world. We're really exporting our inflation to other countries, as we have seen the dollar, again, seem persistently high. Now, why is the dollar high? Because interest rates are high. Today, we had a new year high for the 10-year Treasury at 4.21%. What does that mean? Why is interest rates still continuing to rise? In fact, we were over 4% the day we got the CPI read, which was October 15th, and we're steadily trending higher for interest rates. And that's just indicating that the Federal Reserve has more work to do, because inflation here is still strong and solid. And we're seeing signs of weakness, but not the weakness that the Fed wants. And the weakness the Fed wants is the labor market. And so how do we see that play out? Well, everyone's waiting for everything to hit the corporations. The Federal Reserve is slow down the economy, so corporations stop hiring and actually start laying off, and then start adding more slack in the labor markets. But we actually had a mixed labor report this morning. In fact, we'll get to the recessionary sort of playbook. But in the meantime, we also have buybacks. So corporations are not only solid, obviously expectations have been tempered down. I was on many news shows in the media appearances the last month saying, yeah, the bar is going to be set lower. Corporations are going to exceed that, but earnings are still solid. Now, how do they remain solid moving forward? Well, one of the things is they're allocating capital to rebuy stock. In fact, October 25th is when corporations can start rebuying between now and year end, sort of stock buybacks. And this year, we'll close out the year at $1 trillion, about $900 billion, which is the all-time in the history of the S&P 500 in terms of dollars that corporations are using to their excess capital to repurchase their shares. And they do that for all the various reasons. One of them is just to increase future returns based upon how the shares are basically reinvesting in their company. And so corporations are reinvesting in the future. They believe in their ability to do so by way of $1 trillion. So we have that potential inherent bid between now and year end for corporations and stocks, if you will, to set up favorably. But we have all this uncertainty, even geopolitical tensions, oil war, obviously the UK I just talked about. It really sets up to recessionary current concerns here, because the Federal Reserve wants a recession for earnings. They want a recession for corporate America. They want corporate America to get lean and mean again, because money was so cheap and labor is so tight. So they say, okay, you may have to lay off some people. So what we're going to be paying attention to, what matters most, in fact, on the recessionary indicator that I'll talk about right now, it's 7 out of the 8 sort of points on the list that are indicating, yes, the U.S. recession is imminent. So let's get to part 2, and thanks for watching, and I'll talk about what to expect moving forward, also talk about how we're going to position accordingly. But that's our update for today of part 1. I hope you were left with just enough that you tune in for part 2, and thanks for watching for today.